This video is going to discuss 4 different approaches to placing a stop. Hello, I'm Peter Martin with Trading 212. Now, one of the things I've noticed in my years involved in the financial markets is that inexperienced traders tend to put a lot of thought and effort into how and when they enter a trade, but they put far less thought and effort into where they place their stops. Now, how profitable you are as a trader is as much to do with how you exit a trade as it is to how you enter a trade, and therefore where you place your stop is an important trading decision. It's just as much of a trading decision as when you open a trade. Now, of course, the reason we put a stop loss on a position is to protect our risk capital, and this has a tendency to lead people down the path of thinking, well, I know what my trading size is and I know how much I want to risk on the trade. Therefore, where my stop goes is a function of those two things that I already know, and that's how they decide where their stop loss goes. Which is to say, it's a little bit arbitrary, and what we want to do is to get away from placing the stop at an arbitrary level and instead make it a market-based trading decision. So here are 4 approaches that try to do that. Now, the first one is to base your decision of where to place your stop upon support and resistance levels that you've identified in the market. So let's take a look at a chart and look at an example of doing that. So this is a daily chart of the French CAC 40. As you can see, the price has been oscillating within a range over the last few months, and I've marked on these 2 horizontal lines to roughly mark out that range. So the lower level is our support level and the upper level is our resistance level. So let's say that we decide that we want to sell the CAC, then we'd be looking to the resistance level up here above to guide where we might want to place our stop loss level. So let's say we're going to enter the market where we have this blue line here. So let's say 54.64.5. Let's say that is our entry level, and we've got the resistance level marked at 55.46, and that's 81.5 points away. Now let's say that we want to give ourselves just a few extra points as a bit of latitude. So let's say that we add 10% onto that 81.5. So let's just say 90 points is where we're going to put our stop away from our entry level. So we're selling at 54.64.5, and then we're putting our stop 90 points above that. So that's at 55.54.5. So that would just be a little bit above where we've got our resistance level marked. Number 2 on our list is a volatility stop. Now, this is placing a stop based, as the name suggests, upon market volatility. And as we've already said, the reason we put a stop on a position is to protect our capital. The closer we put the stop, the more we protect that capital, but also the more likely it is that we're going to be stopped out just by normal variations or normal fluctuations in the market price. So the idea here is that we're going to look at how much the market is moving typically, or trying to gauge what we might judge to be a typical market movement, and then trying to put our stop outside that so that we don't just get taken out by what is the normal ebb and flow of the market, so that we can profit from net movement in the direction that we have traded. Let's have a look at the charts to look at an example of this. So this is a daily chart of the German DAX, and for our volatility based stop we're going to need some measure of volatility. So let's right click and look at our volatility indicators to see what's available. So we can see there's quite a few there. At the top of the list is average true range. This is a fairly standard measure in this area, and that's the one I'm going to start with. So we come up with the dialog box that shows 14 periods. This is the span of time over which we're going to be averaging the true range. Now, the true range is a measure of the market's range. It takes into account the current period's high and low, but it also takes into account the close of the previous period if it lies outside the high and the low. So we're going to be taking a simple moving average over 14 days. In this case, I'm quite happy with that default value of 14, so I'll click confirm, and then below our main chart we have a chart of the average true range, the ATR, and we can see how that's changing with time. If we hover the cursor over where we are currently, then we see that the ATR is around about 128 points. So this is trying to give us a representation of how much the market is moving on average over this period. which is another way of saying how volatile the market is. And what we'd be looking to do is to place our stop a multiple of ATR away from the market. So we might put our stop 2 times ATR away or 3 times ATR, just to try and protect us from being taken out by just sort of normal day-to-day fluctuations in price. So let's say that we opt for 3 times ATR. So the ATR is 128, 3 times 128 is 384 points. So that's how far away we're going to be placing our stop. Now let's say that we're going to buy the market, and let's say that we can buy in at 12,300. So 12,300 is where we enter. Our stop goes 384 points below, and that puts our stop at 11,916. So that's using the average true range. Let's try and look at using a different volatility measure. So let's now look at using Bollinger Bands. So I'll click on Bollinger Bands. The dialog box here, it shows 20 periods is the default. That's over which we are averaging. We take a simple moving average to start off, which gives us the middle line that it plots on the chart. And then away from that simple moving average, it plots an upper line and a lower line a certain number of standard deviations away. Then the default value here is 2 times the standard deviation. Let's click on confirm and see what that's like. So we can see there's the upper line and the lower line, and we can see that it does a fairly decent job of tracking the sort of outer limits of where price oscillates to. We do get occasions where it breaks outside the Bollinger Bands. If we wanted to widen them, we could just right click and manage objects and click on Bollinger Bands again and change this deviation value, make it something larger to make the Bollinger Bands go wider. But I'm quite happy with these default values. And so if we look there, if we just hover here, we see the lower Bollinger Band, it is at a price of about 11,862. So we could put our stop loss there, and we can see that that's sort of not too far away from the value that we got with 11,916 when we were placing our stop 3 times ATR away. So there's just a couple of examples of using different volatility measures to try and guide our stop placement. Number 3 on our list is a time-based stop. Now, conceptually, this is different to all the other approaches on our list because you're not actually choosing a market level. Instead, you're choosing a fixed span of time after which you will revisit your position. And if you're losing, then you close the position out. Now, obviously, how long this span of time is needs to be tailored to yourself, your approach, and your trading method. To make sure that it's commensurate. Let's say, for example, that you had an approach where you might expect to hold a position for a matter of weeks. You might typically hold a position for 3 to 6 weeks. And you might choose that your time-based stop should be a span of time that's 3 days, that you feel that just a matter of hours really isn't giving it long enough to decide whether the position has gone right or not. So you choose 3 days. You open your position. 3 days later, if you're losing, you close the trade out. If it's moved into profit, then you look at where the current market level is and then wait another 3 days. If you're losing from that position, then you close it out. If not, if you're profiting still, choose where the market currently is, give it 3 days after that. In that way, you're sort of trailing your time-based stop with the market so that if the market continues to profit, you'll still keep moving your position up with the market, but you'll still have some method of protection in terms of closing you out should things go wrong. Obviously, it's a lot looser, this approach. It doesn't, if the market was to suddenly dump on you, it wouldn't get you out in the way that the other approaches would. So maybe not one for everyone. Number 4 on our list is a percentage-based stop, and this is simply closing your position out a certain percentage away from where you enter. However, we're not just picking a percentage out of thin air, because if we did that, we'd be getting back into the realms of just choosing an arbitrary stop loss level. So instead, and this is a bit more of an involved method, you'd be basing your percentage on analysis either of the market or of your own trading history. So one idea is to go through your trading history would require you to have built up a certain history of trades, and then to compile the data of your winning trades and your losing trades alongside what the market had done whilst the position is open. So when the position is open, this is what we call that, what the market is doing. We call its price excursion over the life of the trade. And what we're interested in is how much it moves against you at its worst point, the maximum adverse excursion. And what we're looking to see is there a commonality in percentage for winning trades when compared to percentage in losing trades. What you might typically find is that winning trades have a lower percentage maximum adverse excursion than losing trades. And if you can see that there's a kind of average, then you could base your stop upon that for the winning trades and use that as your guide as to where to place your stop loss level. But that's just a simple run through of 4 different approaches to placing your stop. I hope you enjoyed this discussion. If you did, please hit the thumbs up button and give us a like. Or if you've got any feedback, why not send us a message in the comments section? We do read through every comment that comes in there. Why not send us a suggestion for a topic to be covered in a future tutorial? Now, as well as these educational trading videos, we also do analysis on other markets like crude oil and Eurodollar and the Dow Jones. And the best way to access all those videos is to click on the subscribe button and subscribe to Trading 212's YouTube channel. And we do put out new videos on a regular basis. If you hit the alarm bell icon, then you'll get a notification the next time we put out a new video. But that's all for this time from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.